CQS Natural Resources. It's an investment trust around about 150 million sterling as we currently speak. It's focused on mining and energy, primarily with that sort of small and mid-cap area, so different from your sort of Rio BHPs. That's because we believe we can find better, more attractive value and names there without having to primarily focus on liquidity. The fund has paid a steady dividend for about 7 or 8 years now. This is a clear focus of the fund. Firstly, it's in the name, growth and income, but it's very much something that we appreciate that shareholders like, and they like to see that income aspect as well as the focus on capital return. We've seen very strong commodity prices, and this is across different areas such as energy, oil and gas, across mining, inputs into electric vehicles. These themes are all prevalent within the portfolio. We have a fairly diverse exposure, but the overriding theme there is actually around the energy transition. We focus on that through names that are more attractively valued and we believe have better prospects, generating better free cash flow, or ultimately just trading at a material discount to their underlying asset value.
We have consciously tried to avoid investing in some of the large cap miners listed in the UK, particularly, which are dominated by iron ore, which we feel many investors are able to more cost effectively buy on their own. The sweet spot of this fund is investing in the less liquid, more attractively valued names.
So in the last year, we've seen a material shift in many of the input costs into EVs, batteries, general electrification. So lithium, which is obviously one of the primary feedstocks, we've seen the lithium carbonate price up around sort of 400 to 500% in the last year. We've also seen material shifts in the likes of nickel, cobalt, and the primary driver of this is that we've seen demand shift far more quickly than supply has been able to adjust. There's just been a real lack of investment in supply for these materials over the last 3 or 4 years. So going forward, we're starting to see a bit of a pickup investment and a bit more focus on that. But there's going to be a real lag time towards that feeding through. There are supply issues in trying to transition through towards this sort of greener future. We hold a core portfolio of good quality producers that we think are very attractively valued, with growth that we think is underappreciated by the market. You can see that with the likes of First Quantum, which is a large position for us. But we have that kind of core earnings-driven part of the business, but we have a really exciting component at the other end of the business, at the other end of the fund, where you'll see smaller kind of development type projects that are trading material discounts to their underlying assets. You see that with the likes of Linus Rare Earths, which has seen some very strong performance. We've had Foran Mining, which is also in our top 10. Again, has been a very strong performer. That is a zero carbon copper project that will be coming into development shortly. You have names like this that kind of feed through, and when they do re-rate, they can re-rate on a basis of multiples. But within the tail of the portfolio, we still have a number of names that we think are materially underappreciated and can follow through in the same way that those other names have.
Copper, a commodity that China lacks, where we still see considerable demand growth. China is some 50% of the copper market. That is ultimately something which is technology agnostic, in terms of not requiring specific battery technology or specific forms of energy. It is just a delivery mechanism. It's been described as the new oil. Well, I think we have to be careful of that, but ultimately copper is something that has consistently figured quite large in the portfolio exposure. Standout names in terms of NAV exposure would be the likes of First Quantum. Whilst we felt the commodity cycle was looking as if there would be more supply constraint, we liked very much First Quantum because it was funding and developing its Cobre Panama copper project. Elsewhere, we subsequently saw the IPO of a company called Ero Copper, which was extremely attractive, bringing back a formerly mothballed state-owned entity. Based in Brazil, it has expansion potential through replicable development of mills, being increasingly aware of the environmental aspects in a lot of investor minds. It being in Brazil is quite exposed to things like hydroelectric power, which give it a green credibility to the value of the copper that it produces.
In the last sort of 9 months, we've been really increasing the energy weighting. So we'd been heavily cautious around energy from around 2015, where we took the energy weighting from being around mid-20s down to sort of low mid-single digits. And this was a very intentional view. At the time, we believed the market was overconfident around pricing, given our view on the US shale plays, and we believed that oil would remain range traded around that 50 to 60 level. What we saw really shift post-COVID was a real greater focus towards emissions and green transition. And we saw that around COP26, with many governments committing to reducing carbon emissions. And this really led to quite a monumental shift in the energy sector, in that it's become even more difficult to add new supply. So the moment that you remove that capitalist response function to higher pricing by adding new supply, at the same time that you're also having increasing demand, as countries re-emerge from COVID lockdowns, then you end up having a tightening market. And this is exactly what we've seen in oil, and it's of no shock to us that oil has shot materially through 100, and we think there could be material upside to that. Because commodities generally have two levels that they sit at. One is either the cost curve support, so i.e. the cost level at which new producers bring on supply. But what we've seen is that function has broken, given the requirements of the majors to focus on emissions reduction rather than adding new supply, and governments aren't allowing new permits into new production. And that's seen oil shoot up to a different curve, which is around demand destruction. So we're now sat at a level that's based more about at what price do people use less, just at the time that we have countries emerging from lockdowns. So this has been a primary driver of why we've increased our energy weighting. Within that, we've got quite a large focus on gas as well as oil, but gas specifically more into Europe, because that we expect that to remain tight going forward.
One of the perhaps cleanest ways that has stood the test of time of providing inflation hedges, gold. Now that's not a metal that we would per se include as our prime commodity exposure. The real reason that we have exposure to it is that the equities are so undervalued compared to the current gold price that we feel actually as an insurance within the portfolio it offers great value. If we were to look within the gold portfolio overall, we would estimate that, depending on the data set that we look at, the type of investment that we would make would trade at something like a third to half of its net asset value, by virtue of being slightly less liquid than many of the preferred names of the larger funds. Companies that have performed particularly well are those that we have managed to invest in during a cyclical downturn. So over the last few years have been developing assets such as West African Resources, which has now commissioned and it is in production, producing its gold at a very favourable cost. For choice now, we would probably be less disposed towards developers, as the inflationary pressures that we see more broadly are impacting development costs, and we are conscious that single asset project developers are perhaps more exposed to cost overruns and therefore value dilution should they suffer any of the consequences of rising steel prices or increased labour content in delivering a new project. For preference, we prefer producers, which West African, as an example, now is.
After years of underinvestment in the sector, across mining and energy, what we're now seeing is resurging demand. So against that increasing demand and a real lack of supply response, we're seeing strong commodity prices. This is leading through to inflation on a global basis, and we're seeing that feed through into fertilizers, into soft commodities. So it's not just the energy crisis that we're all seeing on the news a lot more recently. So going forward, I think this is a fund that really offers people some protection to inflation. It offers very strong cash flows with attractive earnings and multiples, certainly relative to the overall sector, and also is helps in an increasing rate environment. So when you look to how equities are valued, which is based on future cash flows discounted back to a present value today, having companies such as ours that are generating strong cash returns today shows a far lower rate sensitivity. So against the backdrop that we see with high inflation, rate increases, we think our fund offers an attractive way to get exposure to those many aspects and can protect against some of those risks that we see in the market.